Take a look at Treasury yields as investors weigh inflation and news on government spending. Joining us to talk about Treasuries, corporates, and everything else in fixed or floating income is Gilbert Garcia, Garcia Hamilton and Associates managing partner and CIO. Gilbert, welcome to you. And this has been an area that has kind of stayed attractive, if I could call it that. Is it attractive to you to own? We'll start with just kind of Treasuries at these yields, T-bills, what have you. Or do you think there's a risk that rates move higher?
Sure. A couple of things. First of all, thank you all for having me this early morning here in Houston, Texas, where we're getting ready for some hot, humid weather. But thank you for having us. No, I think now is an excellent time to be buying and adding duration in your portfolios just about anywhere along the yield curve. I think this recent perceived deal with China, which is really no more than a pause, I think has given us an opportunity to reload. That's what we're doing, and that's what I think makes sense. I think it's hard to imagine that rates would get so much higher from here, given the weakness that we see outside the whole tariff ecosystem, meaning housing prices, commercial real estate, and the like.
Okay, so if that's the case, and that's an important place to start, because then people can kind of look across the asset class and go, if there's not a huge risk of rates moving higher, then what is opportunistic to own right now? We've seen some, movements in high yield and investment grade, especially back to when the big market sell off in early April. But are those opportunities gone now? Are they still attractive?
Sure. And our view that right now, whether if you look at spread product or risk assets, primarily let's focus on corporate bonds. If you look at corporate bonds from the beginning of the year to now, investment grade corporate bonds are probably no more than 15 basis points wider than where they were at the beginning of the year. That is still almost 150 or at least 100 basis points from the average. So in other words, corporate bonds are still significantly overvalued, and there's really very little opportunity. You could say the same thing in high yield, where while we are about 50 wider on the year, we're still about 200 basis points from just the averages. So I think the place to go is higher quality, which is U.S. Treasuries. And you know what I really like? I really love agency guaranteed mortgage-backed securities because they are at such low dollar prices that you want prepayments. In other words, they have positive convexity. You want prepayments.
But who's prepaying? Who's selling a house right now? Who's refinancing?
Sure. I can tell you right now, what happened in the marketplace is coming out of COVID, we created these very low coupons, 1.5%, 2%, and the marketplace felt that nobody's going to prepay those. Well, I can tell you something. You know what happens? There's always going to be a relocation rate. There's always going to be a death rate, a divorce rate, a bankruptcy rate. And I think the market was surprised that they're still prepaying about 4 to 6%. That might not sound like much to our listeners, but when you run the yield matrix, metrics rather, at those types of prepayments, at these dollar prices in the low 80s, you're talking about yields of about 100 over Treasuries for virtually no risk.
Analyst or investor own that? You know, is that an ETF product? Is that, call your local broker?
Sure. There are ETF products. You can also buy them within mutual funds. It's hard for them to buy them themselves outright because you want to get diversification. You want 30-year, you want low coupons, but it's easy to buy the ETFs. And that's where I think that's the place to go right now. It's extraordinary value for money managers.
Yeah, and just to underscore that you don't necessarily think it's corporates, again, a longtime area of expertise of yours, high yield, you think it just doesn't offer a compensation in case the economy softens, and you just think investment grade. I mean, people might say, look, 4.5% is pretty good, but maybe it's just not good enough.
Well, that's correct. But here's the thing. If you like 4.5%, that's more of a reason why you should look to lock in short Treasuries. The 2-year yield's still just under maybe 3.90 or so. I mean, the 5 years probably right around 4%, and you're talking virtually no risk. It's a great time to be in the U.S. Treasury market, and it's a great time to be in mortgage-backed securities. And now it's not a good time to be in corporate bonds, whether it's investment grade or high yield.
All right. So parting thought on munis, which is where a lot of the retail investor base tends to go. And especially, like I said, a month or so ago, they were starting to look pretty attractive on an after-tax or adjusted basis. Any thought on that?
Sure. First of all, there's two types of munis, of course. There's taxable and there's non-taxable. And most of us always think about the non-taxable. If you look, taxable munis, have parallel corporate bonds, and they've done very well. Now's a great time to go out of your taxable munis into tax-exempt munis. So essentially, take advantage of the tax-exempt coupon payments. I really like those, especially in the intermediate part of the curve.
All right, so like wherever you live, look for those munis in kind of, what intermediate be, like 5-ish, 10 years?
In the 4 to 7 year range, 5 year is definitely the sweet spot. And of course, the reason is, as soon as there's any change in Fed expectation, it gets priced in the market in the forward curve quite rapidly. And the place where it still has a big impact is up to around 5 years. Further out, it starts getting diluted.
All right, Gilbert, are people coming in from staples and dividend stocks because they're saying, why take the stock risk when I can just get these yields?
I think that's right. We're seeing it in our clients. We're seeing two things. Everyone is moving further out on the yield curve. If you have money in cash, you're moving out to the 1 to 3 year. If you're normally in the 1 to 3, you're going out to the intermediate, et cetera. So that's number one. And number two, a lot of our clients and a lot of things we hear in the marketplace are moving from stocks to bonds to take advantage of course, this recent comeback on the stock market. And the other thing, of course, is there's just a lot of activity with bonds being higher yielding of just movement into the bond market. We are seeing more searches for bond new money management assignments, whether it's on the short end, the intermediate part of the curve, than we've seen probably in the last 5 to 10 years.